Today I have the privilege of speaking with David Paradice, one of the true legends of the Australian funds management industry. He's going to tell us a little bit about the background of Paradice, how he got started, what makes a great fund manager, his views on the markets today and where he sees risks, and a great little story about why there's a Dr. Seuss book sitting in his reception. Well, David, thanks for coming in. I'd love it if we could start by getting a bit of an insight into how you started Paradice Investment Management, what made you decide to get out and go it alone, and just hear a bit about those early days as an investor.
I was with ING Group, Mercantile Mutual, from around about 94 to 2000, running small cap money, and we had pretty good performance over that period of time. And the fund had got bigger and bigger, and we had a number of institutional clients that were interested in backing us, but they felt that we were too big. So in 2000, I decided to leave. And I thought small caps is a really good place to be because it does add a lot of alpha, and that some of the larger cap managers were moving more towards index side of things. So I thought, well, we can add alpha with investing in small caps. So I actually left ING at the end of '99. And in beginning of 2000, I went around to see some consulting firms that backed me. So when I started, there's probably only 3 or 4 actual small cap specialist fund managers, and there weren't many specialist mandates. So we had money, two specialist $30 million mandates from wholesale clients. And so I walked around to see these consultants, and some of them said, or actually the 2 main guys said, we're not going to support you. And so I'd kind of left, and I thought I had support. Then I had to rejig things, and then I managed to find a couple of consultants and a couple of clients that backed us back in the old days. And so that was 6th of March 2000 we started. And it was right at towards the end of the tech boom. And so the tech boom was still going for the first 3 months of when we started. And I remember thinking how important it was to outperform over that initial period. And anyway, I remember couldn't sleep one night, got up at 4 o'clock in the morning, and I was going for a run in the rain at Chatswood Golf Course, and thinking how I was 3% down against benchmark, which is quite significant over a 3-month period. Yeah. And not ideal when you're setting up a business and you're losing money, meaning operating costs, losing money. And anyway, I kind of was running around thinking, oh, this is really bad, going to make a mess of this. I was going to be out in the street in a couple of weeks' time. But then I worked out after a while that I'd actually worked out the decimal point was wrong. So rather than being 3% down, I was actually 30 basis points down. So I got pretty happy. So I sprinted back home, got dressed, went to work. And that was probably towards the back end of the tech boom, and then around about May, June, stocks started rolling over. We were invested in a lot of those stocks. We were invested in a lot of the contrarian, cheap value type stocks. And that first year we ended up being 35% above benchmark. So it was very significant. And from that, we've been able to build the business. And that particular fund, our small cap fund, has generated 17% per annum over the last 18 years. We went from 200 million when we closed it after 2 years at 200 million, and we turned that 200 into 2.2 billion. Then we gave back $800 million in 2014, and now that fund is probably up to about $2 billion again from capital appreciation.
You talked about a few things there. You talked about having a slightly contrarian approach, and also, really wanting to add alpha and feeling like you're making a difference from adding value to your investors. Yeah. Can you tell me a little bit about how you think about that contrarian style and why you hold that approach to investing?
It's very significant right at the moment where you're having a lot of money going into passive type funds or quant funds where it's going much more index based. But at the end of the day, what clients want people to have, and what a number of our clients have, and why we have such great clients, is they are looking for alpha generators. So they're looking for people that aren't hugging what we call hugging the index. They're looking for people that have reasonably concentrated portfolios, that are generating returns over and above the benchmark. And every single one of our funds, our 4 products, we run $15 billion. Every single one of our products have added significant value over a long period of time. So it's really important for us to have what they have is what we call high active share, which means we're not hugging the index, that we have concentrated portfolios. We have, one of the things I've also done is have smaller teams of people, not really big teams, because I do think that smaller teams make people much more accountable, and when people are really accountable for their performance, they seem to work a lot better. And I think that a number of our clients, as I said, are really, well, everybody wants to have value add without taking big risks. And I can't stand having fund managers that say want to be up 40%, are happy to be up 40% one year, say down 30% the next year. Over a long period of time, you just want to be able to do 15% year in, year out. And that's why, for example, our Aussie Small Cap Fund is up 17%. Our Global Small to Mid Cap Fund, which is $4.5 billion, which started on August 2010, so it's been going for nearly 8 years, is up 17%. So yeah, they're good numbers, but the volatility is low, and it's done by contrarian, conservative type investing.
Just explain to our viewers that contrarian style, is that looking to buy cheap stocks?
Well, it's actually, it's not so much contrarian. It's just buying. It's just going out and doing the numbers, going out and seeing companies, spending a lot of time just totally focused in on stocks. So, like everybody at our place starts very early in the morning. We don't have any meetings within, say, 8 to 4 o'clock or 5 o'clock when companies are available to talk. So we don't have any internal meetings. All our internal meetings are outside of those hours. Everything is focused to allow the fund managers to be focused in on picking stocks. So it's really important for those guys to be able to do that and not have many things that distract them. And it's so the guys that we employ are guys that are very focused on capital preservation, not this paying up for blue sky. Downside protection is really important for us. So when the market is bad, we do a lot better than the market, and then hopefully, in these very strong markets, we hopefully do in line or maybe a bit behind, but over a long period of time, we do much better than what the equity market produces.
I understand that you're a big fan of the getting out of the office and going out and visiting the companies and speaking to their competitors and really having a look at what the companies are doing on the ground. Can you give me a bit of an insight into the sorts of things that you're looking for and your team are looking for when you're going out to these meetings? What do you want to see at a company? What are some of the things you don't want to see?
Well, we don't like to see excesses. We like to see companies that are managed conservatively and they're managed for the shareholders, not for the CEOs and the executives. Like, we believe that if we do a great job for our clients, that in time, and it's always been our philosophy, if we do a great job for our clients, we'll continue to do well. But as soon as you put yourselves first before the clients, or if a CEO puts themselves before the company, things don't go well. So it's those kind of things. You're looking for all the obvious things that everybody else talks about, which is free cash flow, earnings per share growth, good balance sheets, strong businesses, business with moats, businesses with pricing power, all those kind of things. And just, it's a lot of it is about looking at angles on particular stocks, the different way that you look at a stock. For example, many years ago, I went to, this is really going back a long way, but TAB Queensland, which is the Queensland TAB racing thing. Yeah. And everybody just saw that as a really low growth business. But then, and nobody would go to the meetings. And so I used to go along to the meetings just because I love talking stocks and working out how businesses work and all that kind of stuff. As do everybody that works with us, they've got the same focus on a love of how a business operates. And, I worked out that, if they went and bought South Australian TAB and they put the revenue on the front, that they diversify the business. Weather was a big issue for those guys. If so, they had a few bad days in weather, then the earnings would fall. Fall down. But those kind of what look like pretty boring businesses, you can go and buy another business, plug the revenue on, take the cost out, get earnings growth and conservative earnings growth, meaning not volatile earnings growth, that the market would then start to look at it as a high yielding type stock, which, because the cash flow used to come out of it, and the stock was over a long period of time performed very well. And so it's looking at what might look like a really boring situation, getting good management that coming into a business, and then moving that business to a growth platform. So there's heaps of opportunities, and it could be large, mids and smalls, and that's how we do our business, is having reasonably concentrated portfolios, looking at angles on stocks, looking at stocks which are growing quite strongly, and not following. It's really important that you do your own work, that we do all our own work, and that we don't follow what the market's doing. So that's why over a long period of time I think we've continued to do well, because we're not following what everybody else in the market's doing.
You've managed to grow the business to expand beyond asset classes outside of that Aussie small caps, which obviously where you started. You now have global products, large cap, mid cap products. Where do you think, when you look across the opportunities right now, where do you think the best opportunities lie for you to be able to continue to generate alpha for end investors? Where do you, when you look across the landscape?
Well, what we're finding is that a number of our clients continue to grow. Doesn't matter whether it's wholesale or retail, the whole retail market is growing with superannuation. As we know, Australia is the fourth largest superannuation market in the world. And we're finding that they want us to continue to be able to invest large amounts of money well. And so our opportunity set is to look at things like in emerging markets, things in global all cap, which is a product that we're looking at doing. So they're kind of what we call bigger bucket type products. But it all depends on, and I spend so much time going and seeing stock pickers, guys that are true stock pickers, guys that are finding value and travelling and doing the proper analysis on a particular company, guys that are and I found that the best investors are what we call as generalists. So I've had the situation where I've employed people who have been a specialist in a particular area. So financial services, we had someone a while ago who was focused on financial services, and you find that they begin to push the portfolio into that particular area. So for example, we had a bit of a position, unfortunately, in Rams Home Loans at $2.50, and it halved the first day. But we worked out we made an error, and that's another big thing, is that you need to admit that you've made a mistake and move on. And in our place, if you make a mistake one day and then you work out that was a bad decision, sell it out. And they always talk about, you have a rose garden and you pull out the bad roses and keep the good roses there. What people unfortunately tend to do, and human nature tends to do, is to, if there's a stock that's gone below where you bought it from, there's this human nature thing that says, I want to get that back above where I bought it, but you need to sit back and say, I made an error there. And so when these guys come and work for us, and they work for a big group, and where the big group says, no, you can't have, you might increase the turnover of the portfolio, you can't sell it, you give it more time, it's going to be embarrassing. Well, just get away from the emotion side of things, and if you make an error, just sell it. So it's really important.
That must be a difficult discipline to manage, because stocks can be volatile and go through periods. You must have a process in place to work out, is this a mistake or is this noise? Yeah,
you go back and do the work, and that's why you spend a lot of time talking to companies and is it a situation where the market's got it wrong and they've sold a stock down and you end up buying more, or is it a situation where the model's broken, or what you thought was the valuation of a particular stock it comes out not to be correct, then you need to definitely sell those situations. So in answer to your question, a long-winded answer is we're looking at there's a number of opportunities for us to grow the business, but it's all about the stock picking, and it's all about value adding, especially in this current marketplace where all this market's going, where a lot of money is going to passive. We're finding that we're getting a lot of demand from a lot of our clients for products which value add, and that's our whole focus. Is if we can't value add, if we can't deliver performance, we've had heaps of opportunities of starting products with significant couple $100 million to support a product, to support a team that we might recruit, but we've just felt they're only adding 0.5%, 1% over and above benchmark. We're not interested in that kind of stuff. We're interested in adding a couple of percent above benchmark. We're interested in capital preservation when markets are bad. It's really important for us to focus on that.
You've talked a few times about how important capital preservation is, or outperforming in difficult markets is. I know you've been spending some time overseas, and you obviously must have a lot of conversations with investors. When you step back and think about some of the risks out there, is passive the big risk? What are some of the things that regularly come across your desk that you think about?
It was a big issue. I did feel, I remember many years ago talking to a couple of consultants here, and I was concerned about that passive side, but the more I look at it, it's actually an opportunity for us, because all this money is following, and as soon as you get money following other money, it creates great buying opportunities in other places of the marketplace. And if you talk about where we are at the moment, for example in America, you've got these tech stocks that are quite expensive. You've got interest rates going up because it looks as though the economy is getting quite strong, wages are going up. There are a number of cyclical stocks that have not gone up as much in value, for example in America. But those cyclical stocks are beginning to move. So you might get an equity market, and I suppose this is giving a view on the equity market, where in America it'll continue to go, but the stocks that are contributing to that growth will differ. It might not be so much the technology stocks, what we call long duration equities, so stocks that have got high growth but a high PE, and usually people will discount the earnings of those stocks back to a value, and the discount rate of that kind of will change the valuation of a particular stock. So if interest rates are going up, then the valuation of those stocks tends to come down. It's a bit like bonds. Yeah. And whereas some of those cyclical stocks, which are a value and cheap stocks, will start to move up. So I still think there are, especially for people like us that invest this way, in other words, focused on value, that I think there's opportunities out there.
It sounds somewhat similar to the experience that you had at the end of the tech boom when you started investing. Mm-hmm. Your outperformance came not from market-related exposure, but from not owning things that were overly expensive.
And I think that's right, and that's why I hate to say it, but maybe there is still some value in the resource type areas, yeah. Commodity stocks. That if the global economy is lifting, that will have an effect on resource stocks. We haven't seen any silly buying or silly investing yet in that area, and they would come into what you'd call cyclical stocks, which move up in line with the economy. Mm. So, it does remind me of maybe back in 2000 or 2007. When there are a number of stocks which are still, even though you've got a strong equity market, there are a number of stocks which are unloved there, and that creates great opportunities for kind of investors like ourselves.
Just be keen to take a step away from the investment markets for a moment, just understand a little bit about, I know you have a lot of interest in philanthropy, and outside of investing you've supported people that you think are out there having a go. I'd love to just get a little bit of an insight into some of your other passions and some of the other things that you're interested in.
Yeah, I've always felt that I've wanted to be the wealthiest guy in the graveyard, and probably want my last check to bounce, I suppose. So yeah, I think it's important for people to give back, and it feels really good when I do give back. So yeah, the philanthropic side of it is important for me. I do a whole lot of things. For example, I fund primary ethics, which is teaching morality to children in schools, and it's education and things like that. I spend a lot of time doing exercise, outdoor, bike riding and all that kind of stuff. So it's and I love You know, it's funny, I say to some of my blokes, who are some of the key guys, you know, we've got to think about getting more succession planning, and they might have been doing what they've been doing for the last 10 years or whatever it is. And they say, well, what else are we going to do? We love what we're doing, you know? We love what we're doing. And they're still, even after years and years, they still come in at 7 in the morning, and I can ring them any time of the night or text them any time of the night, and I get an answer straight away. So it's all about having passion and purpose and wanting to deliver that performance, you know.
Great. Well, David, I appreciate you taking the time to give us an insight into your philosophy for investing. I think that's probably the thing that I've taken away the most is, and the things, it sounds like a lot of it hasn't really changed over 18 years with how you approach investing.
No, we have, in our foyer, we have Dr. Seuss's book, Hort and the Elephant.
I actually meant to ask you why that's there. It's quite random.
It's quite random. So there's Maisie the lazy, no good for nothing bird, who I sometimes call my sister that. No, but she's not lazy at all. No, but and Maisie wants to go off to Miami or to Palm Beach for a holiday, and so Horton the elephant's walking past, and she's sitting on an egg, and she says to Horton, "Look, I want to go for a holiday. Can you sit in the egg?" I said, "Sure, I'll do that." And so she goes away, and then it starts snowing and raining, and his friends come in and laugh at him, and every time he says, "An elephant's faithful 100%, meaning I say what I would do, and I'm going to keep doing what I do, and so that's what our business is like that. Whereas we just, you know, we have to keep on evolving with the changing times. You know, like investments, the way you look at investments. Like many years ago, it used to be capital rich balance sheets. You know, but that's moved away a lot from that. It's about return on investment, it's about earnings growth and all that kind of stuff. So you have to evolve on your thinking. And in some respects, when I used to run small caps, it was really good that I probably moved on a bit, because I got a couple of young blokes in that were good on the technology side of things. And you can't ignore that stuff, you know. So you have to keep evolving with the markets. And but at the end of the day, everything that drives stock prices is talking about making good investments, return on investments, IRRs, net present values, cash flows. But you can't avoid this technology change that's happening. And if you put your head in the sand and said, I just want to keep buying asset-rich companies, and we've seen what's happening with asset-rich companies with shopping centres and stuff like that, you need to be careful by putting your head in the sand. But, you know, the Hort and the Elephant story is about doing the same thing year in, year out. And you know, making sure that clients trust and don't have any surprises.
Great. Well, again, thanks for sharing that story.
No problem, mate.
And thanks for coming in.
No problem. Thanks.